Google has been on an incredible run up 67% year to date. And over the last 5 years, the stock has nearly tripled. For a lot of people who bought here at the end of 2022 or during the dip in 2025, such as myself, you might be wondering if now is a good time to sell your Google shares. Is the price of Google getting ahead of the fundamentals of the company? The whole point of investing is you want to buy low and sell high. So, is this the perfect opportunity to sell high? Today, Google is a pretty significant part of the rated A portfolio. It's 5.5% of the entire portfolio, and our average price is $164 per share. We were buying right around here at the start of 2025. And back then, the narrative around Google was much different to what is currently being said today. It's really insane just how quickly things move and narratives change in the investment world. It was only 6 months ago that Google was the kid on the block that nobody wanted to own. Compared to the rest of the Mac 7, Google was the stock that was trading for the cheapest. Nobody wanted to touch it. And most of it had to do with the AI challenge. Since then, Google stock has pretty much doubled and a few things have changed. And so a key question I want to answer in this video is whether sentiment has gone too far. Are investors turning way too exuberant about Google? Are their expectations way too high? So much so that the future returns we can expect from Google stock are now not as good. And is it time to sell our shares and move our money into better opportunities? You are watching Rated A, and on this channel, I am building in public a database, a full database of hundreds of companies. All of these companies will be rated based on their quality so that we can know ahead of time which companies we want to own in our portfolio. And most importantly, when is a good time to buy them? Because it's not enough to just buy high quality companies. If the price you pay is too high, it can absolutely destroy your returns. And so, while it's important to focus on the fundamentals of any company, you have to buy and catch that stock at exactly the right time. The whole point of the value rating and the income rating is to let you know which companies are the best opportunities in the market right now and which companies you should stay away from. Now, this is not just theory. We are putting this method into practice with the Rated A portfolio, and so far it's going great. 33% for 2025 versus 17% for the S&P 500. We are crushing the index. Also, if you are already investing and have a portfolio and want to talk to me one on one, we can do a portfolio checkup. I can go over your holdings, tell you what I think about the stocks in your portfolio, and all of this for free. You just have to sign up in the link that I'll leave in the description below. Okay, that's enough admin. Let's get to the video. In order to fully understand the situation and what's going on and should we sell Google or not, it's important to kind of rewind the clock a little bit and go back to 6 months ago. What was the market thinking when it was selling Google shares at $150 per share? The first big part of the narrative was the United States versus Google lawsuit that was brought to the company. It was an antitrust case where the DOJ was saying that Google was a monopoly and it was using its size and its monopoly power unfairly, especially in the advertising market. This case was brought in 2023, but by 2024 and 2025, especially at the start of this year, there were still doubts as to what was going to happen because clearly Google was losing this case. And one of the potential remedies brought by the DOJ was a full divestiture of Google Chrome. This would have absolutely hurt Google's business model because a lot of Google's product offerings rely on Google Chrome. In a way, Google Chrome is what ties the entire ecosystem together. It's what allows Alphabet to own the user in a way. That's how they get your information, that's how they get you to stay on their platform. It's also what makes Google so good at advertising, is that when you go to any website using Google Chrome, Google takes note of that and gives you better advertisements that are more likely to fit for you. So that was a big sword hanging over Google's head at the start of the year, and one of the reasons why the stock was so cheap. The second reason why Google was so cheap is none other than ChatGPT. There were fears that ChatGPT would render Google's search business obsolete. Google's method is antiquated. You look up for something, you get 10 blue links or more if you go to the further pages. And companies pay Google in order to be featured at the top of the list. ChatGPT and other LLMs completely changed this model up. You ask ChatGPT a question and it answers you with the best answer. The theory was that people are now using ChatGPT and other LLMs more often. They're just better at surfacing information than Google, and therefore Google will lose traffic, will lose ad revenue, and at the end of the day, Google search is Google's main business. It's their main cash cow and their main source of a moat. A lot of things have happened since the start of 2025. First of all, we got an update to the antitrust case, and the federal court has decided that the DOJ's call to break up Google and to separate it from Google Chrome is not necessary. For obvious reasons, as I've already explained, this is a huge positive for Google, and an overhang on the stock has been lifted off. The second notable thing is that Warren Buffett actually invested in Google. And it wasn't Warren Buffett, it was Berkshire Hathaway. But it's a big sign of confidence in the stock when someone like Warren Buffett gives his stamp of approval for buying the stock. And it wasn't a small purchase. $4 billion. This is a significant purchase even for a big company like Berkshire. This purchase happened somewhere during the third quarter of 2025, so we can assume around $200 per share. What's interesting is that the rest of the developments for Google aren't new. They aren't catalysts that have been big changes for the stock price, you would think. They're things that were always happening in the background, but that people were choosing not to focus on. The first one is Waymo. Waymo remains one of Google's best options for the future. There's a lot of optionality in this business. Right now, it's not making any cash flows at all. It's actually a drag to the overall business because it's unprofitable. But Waymo has the potential to change the world, and Google is in the lead when it comes to driverless vehicles. Waymo is expanding. They're reaching London, where I live in the United Kingdom, in 2026. They're reaching Japan soon as well. They're already in many cities around the United States. And so they're just way ahead of other competitors like Tesla gets mentioned a lot. BYD is another one. Uber is another one as well, but usually they either partner with Waymo or with Tesla. YouTube is also still doing really well. During the third quarter, Google reported that YouTube revenues grew from 8.9 billion in the third quarter of 2024 to 10.2 billion in 2025, growing really quickly. The cloud business is even growing faster than that, from 11 billion last year to 15 billion this year. Firing on all cylinders, Google Cloud is another leader in its respective industry. You could say the same about any of Google's businesses. But the most interesting thing is what's not happening, because if you look at the Google search, it's growing as well. So clearly what's not happening here is that Google search is just going down to competition, namely ChatGPT and OpenAI. When you keep waiting for a bad thing to happen and you price that into the stock, and then quarter after quarter after quarter, your idea gets kind of refuted because of the numbers, at some point, the story stops making sense and the stock price re-rates itself. Eventually, people change their minds. Over the short term, the market is a voting machine. Whatever people's narrative is in focus, that's what's going to drive the stock price. But over the long term, the stock market is a weighing machine. And that's where the numbers, the revenue growth, the free cash flow growth, the fundamentals, the competitive positioning, all of this is the most important thing for the long term trajectory of the stock. The last piece of news that sent Google stock skyrocketing is the announcement regarding TPUs. TPUs are just Google's answer to GPUs. Right now, the company is relying a lot on NVIDIA's chips, and it's not just Google, the entire industry is completely reliant on NVIDIA. Google is changing that dynamic by developing a replacement for those GPUs called TPUs. Google is in partnership with Broadcom to manufacture these TPUs, and recently an announcement was made that Meta was going to start buying Google's TPUs. The implication here is that Meta is diversifying away from NVIDIA and that soon many other big tech leaders will start doing the same. Once again, the market took this as news, but Google has been working on this project for a very long time. Big tech has been trying to replace NVIDIA's chips and their reliance on NVIDIA's chips for a very long time. It's just another episode of the market not being efficient. That's my personal opinion. So, in summary, a lot of things have changed. The narrative is now a lot more positive than where it was 6 months ago. Everything is pointing in the right direction when it comes to the story. Now we need to figure out, do the numbers back this up? Or is the pendulum swinging too far the other way and the market is voting Google shares up again? The thing is that right now, no matter how you want to look at it, Google's valuation does seem stretched. We've got a free cash flow multiple of 77, but that multiple is misleading. Right now, Google is spending a lot of money on capital expenditures. They need to build out all their data centers. Therefore, they're investing a lot to grow further in the future, and that is hampering down their free cash flow. Despite the operating cash flow growing year after year, the capital expenditures are rising, and therefore the free cash flow is not growing as fast. But we can give Google the benefit of the doubt. At the end of the day, we want our companies to be investing for growth, not just milking out all the profit that they can tomorrow. If we look at earnings, on the other hand, the PE ratio is currently 31, getting close to 32. At first glance, this seems a lot more reasonable for a company that's such high quality and growing so quickly and a very bright future. But some people have correctly pointed out that Google's current earnings are heavily affected by other income. This line right here. This line accounted for 6 billion of Google's earnings in 2024. This year, it's closer to 27 billion. That's a significant amount, and because it boosts the overall earnings, it lowers the PE artificially. So we need to understand what this includes. And actually, for Google, this includes all of its investments. When Google's investments go up in value, that's capital gains, but for a corporation, it counts as income. In other words, in 2025, Google's companies that it invests in have been growing a lot in value. But this is not cash flow. This is not money that Google can use to reinvest. This is paper value. So you need to be able to take it with a grain of salt. And it's difficult to know exactly which companies are included in this basket, but one prominent example is Anthropic. Google has a significant stake in Anthropic, and that company has been on a tear similar to OpenAI, and it might be contributing a lot to the 27 billion. If you remove this number from the earnings, all of a sudden the PE ratio goes closer to 40. So not nearly as cheap as 32. And it does imply some type of exuberance with the stock. Yes, Google is expensive no matter how you look at it today. With a little help from our calculator, at today's price, assuming a growth rate of 12% for the next 5 years, let's be very generous and put some great margins on the free cash flow. This is what Google is able to achieve when it's not investing so much in CapEx. Some share buybacks, a terminal multiple of 30, let's say. We get a really poor return below 3% per year for the next 5 years. This shows that Google at these levels is not very compelling. But does it mean that we need to sell? Not necessarily. Warren Buffett and Charlie Munger have made their career transition by going from value investors, cigar butt investors into quality investors, picking the right companies and letting them compound despite the market fluctuations. If you hold a gem like Google in your portfolio, a company that's such highly rated when it comes to quality, just let it run. Sometimes the market will offer you a very depressed price for it, sometimes a very exuberant price, but it's not worth trying to sell it at the exuberant price to buy it later. At that point, you're just market timing and you're just hoping that you have available cash when the stock goes back on sale. It's a lot easier and a lot better for your peace of mind to just hold and let time do its thing. But there is an offer that would be too good to be true, a Godfather offer. If the market offered us 400, 450 per share in the next few months, at that point, I think even I would trim my position or sell it completely because at that point, the market would be hallucinating and the valuation would really not make any sense. As of today, Google is around 6% of my portfolio. I'm not selling at this price, even though it is an exuberant price, just because Google is such a high quality company. It is one of the core holdings in my portfolio, and I expect to hold it for decades, as long as the quality remains strong and the fundamentals look good. But like I said, this is not always going to be the case. If the fundamentals end up looking worse and worse, at that point I would sell, especially if the valuation stays this high. Also, if the market offers me a Godfather offer, such as $400 per share, at that point, I would really have no choice but to sell it and find a better opportunity. That's it for this video. I hope it was useful for you. Tell me, what are you doing if you own Google? Are you keeping it in your portfolio or are you selling and finding better opportunities? Let me know in the comments below, and I'll see you in the next one.